The market is getting manipulated. People move prices up and down in order to maximize liquidations, in order to make money when others lose, when they take on too much risk. The question is, does it make sense to potentially use that data, that liquidation data, in order to predict prices? In this video, we are going to dive into derivative data, so into data of the futures market and of the options market. We're trying to find out that the people that bet on the Bitcoin price have some kind of insight of where the price might be going. Now have a look at this. This is the futures liquidation volume over time for Bitcoin. And we've got this for the shorts, and we've also got this for the longs. We can also look at the net liquidation volume. That's this squiggly black line. Now we see a major bottom over here on the 26th of October of 2022, but not much has happened with the price on that day. We see various spikes over here, but again, those tend to not necessarily be any specific points in the price chart. It seems like there's really no real connection between the liquidation volume, so the volume where people get stopped out of their positions forcefully, and the Bitcoin price. So whenever we hear news about how people got stopped out of the market and how there's now much less leverage in the market, probably those news are pretty much just noise. They're irrelevant. Otherwise, it would be much easier to find a pattern here. But there are some data points of the derivative market that might be useful. For example, over here, this is the trading volume of the options market. So both of call and put options. So of bets on the price that have a limited duration that expire at one point. And the trading volume of those bets on the price tell us something. When this was very, very low at the end of 2022, this was also when the price was very low. When this is very high, we might not necessarily be that low in the price anymore. Now here's the other major derivative, right? The bet on the price, where we don't directly move Bitcoin, but we simply just bet on the price. Here are the futures. So this is the trading volume of futures. And again, we see how this is extremely low when Bitcoin is at its lowest. In other words, what I believe is going on here is that the people that tend to speculate just short term on the price, they also just go with the cycles. So when nobody is interested in Bitcoin, then those professional traders that trade options and futures, they tend to be not that interested either. They tend to not trade that much. But then vice versa, when there is a lot of trading activity of those futures, we tend to peak out in the price, as happened in the middle of March of 2022, or as might be happening right now. Who knows? We're definitely not at the levels of the end of 2022 or the beginning of 2023. Now, there are two major metrics that are useful from the derivatives markets. On the one hand, it's the trading volume, but on the other hand, it's also the open interest. So when you open a bet on the price, you're betting with a certain amount, and then you keep that rolling until the bet expires. Now you can look at how much money is now currently bet in aggregate on the price. So this is not the trading volume, this is the open interest. And here we've got this for the options, and again, it tends to bottom out when the Bitcoin price is also very, very low. And it tends to be high when the Bitcoin price potentially is heated. Then in 2021, when Bitcoin was just at 60K, right? The open interest on the futures market went from 13 billion all the way to 43 billion or so. A 3x in the open interest, while the price only went up by 50%. Here's the same for the futures market. Again, a very comparable picture. The open interest on futures were at around 20 billion. Now it's at around 60 billion. A 3x in how much money is currently in short-term bets on the price. And unfortunately, there is a positive correlation between those bets and the price. In other words, we want to be in the market when there is not that much speculative money in Bitcoin. And we want to avoid the market when the speculative money, the bets on the price with options and futures is peaking. Now, this is the Bitcoin futures open interest in US dollars. We've also got the same in Bitcoin. It looks like since Bitcoin is at around 30K, the open interest tends to rise again. But this doesn't necessarily tell us what those speculators think about the direction of the market, right? If they are now betting on rising prices, say with call options, or if they're betting on falling prices with put options. Now with the perpetual futures, there's a concept called funding rates. When the funding rates are positive, then most people bet on rising prices and vice versa. And so the funding rates got extremely positive when Bitcoin moved from 10K all the way to 50K, and then that turned around very, very quickly once the bull market stopped, and when we then moved from 60K down to 30. We can also see how the market was at maximum bearishness when we bottomed out in Bitcoin at 16K. In other words, it might make sense to go against the grain at those extreme periods when we have a very, very positive funding rates, and we should be buying when we have extremely negative funding rates. Most of the time we have slightly positive funding rates, as we do right now. Only in extreme scenarios this seems to be a useful metric. Outside of those extremes, it's not really clear. There seems to be generally a positive bias, as in if we hover around the zero line, the price might be going down. If we are positive, the price might be going up. And currently we are still up, right? We are still positive. Now we don't have to necessarily just focus on the derivatives, right? We can just have a look at the trading volume on the spot market itself, right? If we buy Bitcoin directly and we order this, for example, for our hardware wallet, or we have this spot in our centralized exchange wallet. The trading volume on the spot market is over here. We've got the buy volume and the sell volume, and those volumes tend to correlate to a degree. So this is the buy volume, and over here we've got the sell volume. And it seems like when the spot trading volume is low, we might have a potential buying opportunity. When the spot trading volume compared to historical levels is high, we might potentially sell. Now this didn't necessarily work over here, right? This was some kind of a flush out of the market. A lot of people capitulated over here. This is when FTX collapsed. But yeah, it might be some kind of indicator for a turnaround. Whenever trading volume is high, we might turn from a bull market to a bear market, or from a bear market to a bull market. And currently the trading volume is again at historical heights, and we have been in a bull market. So this would not be too great. So different models give us different results. Obviously, no model is perfect. Some models are useful. I'm personally still invested. I still hold a lot of Bitcoin, but I am very cautious. If we go below 90K, then I will de-risk quite a bit. That has something to do with a backtest that I've made with moving averages, etc. I talked about this prior on this channel. I will talk about this again in future videos as well. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video, or potentially see you in premium. Feel free to check out the premium membership. There is a 7-minute video on the website below, so feel free to check it out. See you over there as well. Cheers.